looking at the policy report yesterday, the banks see inflation getting to just above 2% by the end of this year. To what extent is that also underpinned by cost-driven inflation? And the reason I ask is because we're beginning to see signs of PMI prices paid moving a lot higher as it pertains to manufacturing. How much is that being factored into your forecast right now?
No, you're right. It's certainly been a feature of the current environment. Again, one to be careful about focusing on particular things. As I say, what you saw through last year, not just here but elsewhere, and this is entirely unsurprising, was a big drop in spending on things that expose people to infection risk. Whether that was a decision taken by individuals or by governments in the form of lockdowns, clearly those were the areas hardest hit, while other areas saw quite strong growth. So what you've seen in many countries is a softening, broadly speaking, in services inflation and a strengthening in goods inflation. Some of that is costs, having to deal with new safety measures, for example. Some of it is merely the relative strength of demand. Some extra costs may have come about recently through increased trading costs, but it's important to bear in mind the overall picture, and the counterpart of that strength has, as I say, been a weakness in services and inflation. So the overall picture for the CPI in aggregate is that we think inflation, I should say it's currently being depressed by temporary things, VAT cut and some energy price effects. Once you take them out, you're getting back, inflation will bounce back up. It'll still be below target, and then we think gradually reconverge with the target thereafter. But as I say, it's a very unusual environment in which different bits of both demand and inflation are going in different directions.
Well, to follow up from that, there's a table in the monetary policy report that caught my attention because it shows that inflation rate does get back to target, but assuming market interest rates, and market interest rates, at least the ones that you included in your report, are minus 10 basis points. So it seems to me that in order for the Bank of England to reach that inflation target, you would actually have to cut rates. How are we supposed to read this?
Well, the numbers are pretty marginal. I think actually the trough is minus 7 or something. I don't think it's quite minus 10. And so the differences are very, very small. If you compare the forecast conditioned on the market curve with the forecast assuming constant interest rates, the differences are very, very small indeed, certainly compared with the overall width of the fan chart. So I wouldn't read too much into that. But clearly, when you're very close to the lower bound, you want to ensure that support continues. And so in some ways, more important than all the procedural stuff about the feasibility of negative rates, I think, was the fact that the guidance we have and have had for several months remains in place, that the MPC will not even begin to think about withdrawing any of this and keep monetary policy relatively loose until we see very clear signs both that the economy is returning to potential sustainably and that inflation is returning to target sustainably. But the overall shape of the market curve for interest rates is pretty flat, I would say, in the grand scheme of things.
Well, to put it all together then, given what you just said, is it fair to assume going forwards that out of all of the tools available in the toolkit, and here I'm talking about forward guidance, interest rates, and asset purchases is the policy instrument that the Bank of England will be leaning on the most should we need to get more stimulus back into the economy?
No, I don't think so necessarily. I mean, we have yet to take that decision. I mean, I think what you should read is that all these options remain open. We have not ranked them. We wanted to ensure that at the very least, it wasn't the sort of technical feasibility of negative interest rates that might prevent their use. I mean, there are deeper issues, some of which we outlined last August about their effectiveness, but that's, the technical feasibility certainly shouldn't be something that stands in the way of them. But we've not sort of ranked them in that way, I don't think. and we would take that decision at the time if we think, if we thought we needed to ease policy further.